Hello, this is Derek, and in this video I'm going to be going over some information that was said on Friday's CNBC reports by Dennis Kneale. And I'm going to title this the Economic Report for the 8th of September because it'll be close to that point when it gets uploaded. Anyway, he was mentioning how there are 4 key areas of numbers that are contradicting themselves: stocks, jobs, gold, and housing. I got notepads, so I'll be going through this for pretty much the entire video. And great news, he said, quote, great news, we lost 216,000 jobs last month, down 600,000 a month earlier this year. Bad news, the unemployment rose to a scary 9.7%. It's all in how you look at it, all how you feel about it, unquote, from Dennis Kneale. So, anyway, he's basically saying that it's great news that we're still down 216,000 jobs. It's almost like saying, well, we were down 7% before in the stock market, now we're only down 2% last year. As far as the stock market of jobs is concerned, we are getting lower numbers, and it really isn't great news when you throw in the bailout morphine stimulus package that we've had. Then the first guest that he had, Harry Dick, who he referred to as a depression monger and a bear. Harry says the problem of using unemployment as a lagging indicator, which is what the mainstream has been doing, is in this case we have a fragile banking system, a fragile housing recovery, and he sees that unemployment triggers defaults, which is actually correct. So after that interview was said, he had to say something else again. I'm going to quote unquote again. So quote, unless it turns out, Matt Shapiro, you bullish gentleman you, that instead it turns to be a peak. You know, I saw it going from 9.4% to 9.7% actually could be a good thing, that we might as well get the worst behind us and move on with the recovery. What do you say, unquote? And quote, I agree, Dennis. I mean, clearly we have seen the bottom and we have seen the worst, unquote. From, of course, Matt Shapiro. So they say clearly we have seen the worst. Clearly we have seen the bottom. And how is it so clear for you to see? Because it's interesting when someone comes on and says clearly this is the case, and they support no evidence whatsoever. To me, this shows that they're running lower on tricks to try to fool us. At least that's my perception of the thing. But I mean, I guess it's smart to listen to these people on there, because Dennis actually said that how interesting that the Dow is up 8% year to date and how the NASDAQ is up 28% year to date. He said that he has never ever seen a divergence like this in years. Yet, I guess his memory is kind of short, or he started following the market maybe in around 02 or 03, because we seen the NASDAQ go from, what do I got here? It was 1950 in September 98 to top less than 2 years later at 51. So we seen the NASDAQ gain something in the area of like less than 200% during this time. And over the same time, the Dow Jones went from like 7,800 to 11,000. And then on the way down, we seen the Dow top from 11,000 to about 7,200, and the NASDAQ go from 51 to 11. So the divergence there was like a 30-something% loss compared to like an 80% loss. I would have to say that is a pretty decent divergence. So unless he's just reading the lines like a lot of journalists tend to do, maybe that's the reason why. We'll see. They started then talking about the metal gold, and they had this guy named Rishi on the show, and he said that gold is pretty much useless thing, and intrinsically doesn't hold that much useful value, and he is calling a bubble very, very soon. Okay, so he's saying intrinsically gold doesn't have that much value. And I'm not going to say that I don't disagree with you, because I have been on here a few times stating that the reason that I think silver is going to outperform gold is due to the intrinsic, the actual real value in which that the metal has compared to gold. Now, the thing about it is intrinsically, the dollar doesn't have much value whatsoever. Ever since they went off that gold standard back about 4 or 5 decades ago was the process they've been doing it, quite frankly, it's been, it doesn't got much value to it. But Dennis Kneale came on stating that gold isn't that great against inflation, because if you were to buy gold today at its, or sorry, 1980 at the top, inflation adjusted, you would still be down half of your value. Interesting that he says it. Now, it's actually be worse than that, actually, because at that point, if you use real inflation, inflation like, say, something like a shadow stats, it would be down like 70 or 80%. That's how much gold has been pushed down, and silver's been pushed down even worse. So with that being the case, if you like to talk about since these points where we're at, inflation adjusted, all that fun stuff, well, how about this one here? The stock market, since its 2007 peak, is down well over 30%, and that's not even inflation adjusted. But if we do these inflation adjusted situations, the Dow Jones CPI inflation adjusted from 2000 is down 35.5%, where gold since that time is up around 200% and about 300% from its bottom. So if that's the case, we can make fun and have these numbers from all of these different point of views. In fact, wouldn't it be smart to say, instead of from the bottom or the top, from like the medium range, this is what it's been? Because come on, it's not like that many people truly sell on tops, buy on bottoms, unless they're consistent liars or they have the inside information and they would most likely, I don't know, work at Goldman Sachs or something, or they'd be, I don't know. That's just you never know, because I don't think too many people have the best of inside information. Now, one guy sees gold going up for a few months and then pulling back when the economy starts to fall. And I would tend to agree as far as going up and then pulling back down on gold, because that is very normal technically. When we see gold go from like 11, 12 up to 13, who knows how high it gets to, it's going to have to take a serious retracement back. I'm getting to the point now where it seems as if it's most likely that the next time gold and silver has a retracement back to the downside will be after its major breakout gain. So silver goes to 24 and then might come back down to 18. Stuff like that there would be to be expected. And then when the economy or the stocks really has these big legs down, it's going to be kind of interesting to see exactly what gold does. Because will gold just flatline, will it go down with it, or will money from stocks go into gold? Because on Tuesday what we've seen is we've seen a very big sell-off on the stock market. Now, it was able to regain it on lighter volume, but the key thing was the selling came earlier in the day on heavy volume. And then on Wednesday and Thursday there was buying on gold and silver with heavy volume. So I'm starting to wonder now if the money that came from stocks on Tuesday was put into gold and silver on Wednesday and Thursday. It just seems as if it's the most likely scenario right now for this to be the case. Anyway, thank you for watching. I won't be able to do too many more of these outside videos, because when the summer ends, that means the wind picks up, and it's really tough to battle the wind here. I have to wait for days that aren't so windy, and today has definitely been one of those. So thank you very much for your comments, your ratings, your subscriptions, and yeah, thank you on that Thank You Banks video for just helping out with all the great comments. The average rating was like 4.95. That is tremendous. So thank you very much, and have yourself a great day, everyone. Bye-bye.